All right, I'm going to pull the charts back up this morning, see where we are. All right. Yesterday, the Dow finished almost 3,000 points higher at 7.87% higher. The Nasdaq over 1,857 points higher, 12.16%, and the S&P 500 474 points up, 9.5% plus for the S&P. All very good, you would think, but my next guest, who is in finance, he's still a bit conservative about what he thinks we should be looking at here. Terry Sawchuk, the founder of Sawchuk Wealth. Terry, nice to have you here today.
Good morning, Steve.
Good to have you. Look, give me first of all, your reaction yesterday. Donald Trump comes out and says, look, everybody wants to make a deal except for one country who came after us. So 90-day pause for about 90 countries, apparently. It's a 90-90 deal, except for China, who's now had its tariffs raised to 125%. What do you make of it all?
Well, obviously the bond market was giving them some heartburn yesterday, because I think it might have been around midnight. It was a little after, but the 10-year Treasury yield got all the way back up to 4.51%. And this is the thing that Scott Bessent has said is so important, and I tend to agree. We have to get interest rates down, long-term interest rates down, because we've got about $9 trillion worth of debt that we have to refinance over the next 6 to 9 months. So it's really important that rates come down. So they had to do, I think, what they had to do in order to calm the bond market down. And it was smart, because in the end, they're going to renegotiate these trade deals. Now, whether they last long-term, who knows? But, they're coming to the table, and we'll see what that looks like. But I think on a short-term basis, this is mildly bullish for the stock market.
It certainly was yesterday. I mean, look, people like me had become fearful of even looking at our portfolios because we had taken such a beating. And so did a lot of people. I'm sure some of your customers got, pinched. A lot of folks did. But it didn't come all the way back. There's work to be done. But looking at this historically speaking, after events like the last few days, generally, you look down the road a year or two, and the markets do even better than they were doing before such an upheaval. Do you think that holds true here, or we have a different situation?
I think it's pretty different this time, Steve. One of the, when you look at those charts, they're just a snapshot in time. And, what's different today is that the United States has $37 trillion in debt and growing, as you know, right? We've talked about this a lot. We had a demographic tailwind with the baby boomers in the 1980s who were in their 30s. Now they're in their mid to late 70s in some cases. So I think that, the tailwind that we had isn't there. All that being said, I think Trump realizes that we need to realign the global trade system. And that's not going to come without some bumps. But if we can get past this next 12 months, I think the scenario gets far more bullish.
Well, let me start with this. Let me start with the 90 countries or so that apparently have come to the table. It's Japan. It's South Korea, it's Taiwan. I mean, these are major importers and exporters of products we need, like microchips, easy example, motor vehicles from Japan. If we negotiate deals, I mean, there's a reason there aren't any Chevrolets driving around Tokyo or Berlin or London. It's because there are huge barriers to our vehicles going in there. So by eliminating trade barriers, and we'll leave China off the table for now, doesn't that create great opportunity for manufacturing here in America? We've already seen $7 trillion dedicated to come here. To me, it looks like a positive all the way across the board. More manufacturing in America, even tariffs, so that our cars can be sold there, theirs can be sold here. Everybody's equal. What do you think?
Yeah, I think generally speaking, it could be better for the United States corporations to at least have more access. Japanese are pretty patriotic. Even if you lowered the tariffs to zero, would they buy American cars? I don't know. Maybe not. We'd have to, we'll cross that bridge when we get there. I think in the big picture, this is going to be good. I think the U.S. economy has not been working for the average person for a long time. Now, keep in mind, though, Steve, that if the economy works better for the average person, it doesn't necessarily mean long-term it's better for Wall Street. And I'm not saying it's not. I'm just saying that there's no guarantee that it is. And I think, through this process, it's going to be more important to do two things. One, you have to manage risk. And you mentioned our clients. Our clients really have done very well in this stretch because we didn't lose a lot because we didn't take a lot of risk during this stretch. You have to have hedges in place, and you're never going to time the market, to catch the very top or the very, very bottom. So you have to scale out when risk is high, and when the risk looks a little bit better, then you can scale back in. You have to be nimble in that regard. But this is going to be a bumpy ride. We are not out of the woods. We may go back and retest the lows on a short-term basis before we make a more durable bottom.
Well, it's interesting that you mentioned scaling in and scaling out. Warren Buffett, for the last 90 days, maybe 120 days, was moving into cash. It was in headlines. Everybody saw it. It wasn't a secret. If Warren Buffett's moving all of his assets into cash and pulling them out of the market, wouldn't savvy investors say, maybe I should do what he's doing? After all, he's made himself billions of dollars. I mean, it's kind of an obvious sign, isn't it, Terry?
Yeah, we have tools that, we use pretty rigorously. And so from our standpoint, it was definitely telling us that it was starting in the early part of March, it became much more clear that it was risk off. Warren Buffett has $300 billion in cash, but he also has, over $1 trillion in assets under management. So he didn't go completely to cash. But what he does is he raises cash and then he buys when there's blood on the streets. And we're not there. Like I said, I think this was a bullish turn yesterday. There's no doubt. But I think on a short-term basis, there's still some testing that needs to be done. The market's down another 3 or 4% in pre-market trading today. So we're going to give a little bit of that back. We'll see where the day ends. But I think we'll probably, noodle around, maybe retest the lows before we make a more durable bottom. And then, we'll see what happens over the next 90 days. But my concern, Steve, is that big tranche, almost $9 trillion of debt that needs to be refinanced. The whole world knows now that we're sensitive to the Treasury market. We have to sell our bonds. Scott Bessent says his job is to be the best bond salesman in the world, and that's true. We've got to sell bonds over the next 9 months, and there's a lot of bonds to be sold.
Well, how important is it? This will be my last question. We're going to be up against time here, but shouldn't the Fed? I'm looking at oil prices that are at about $60 a barrel, which is $20 less than it was just 2 weeks ago. Gasoline prices are coming down daily. They're going to be well below $3 pretty much in every state except California here shortly. Doesn't the Fed need to take a look at this and drop interest rates at least once or twice in the next 6 months?
Steve, you and I have talked about this, right? The Fed has turned into a political animal. So what they should do and what they will do are probably two different things. I mean, Neil Kashkari was just out yesterday, who's one of the former Fed chair governors, said, basically that we need to see long-term inflation come down more. I'm like, where was this conversation at in September of last year when you cut rates right before the election?
Exactly.
All of a sudden, now you're worried about long-term inflation rates.
Yeah, well,
so I don't think the Fed's going to come in and bail us out right away. I think at earliest we might get a July cut, maybe.
Well, that's all right. I mean, I'm looking at what the economy looks like a year from now for the political ramifications. Anyhow, the Dow shows it's going to be down about 400 points to open. That's about a percentage. S&P 500 down about 1.5 points. Same thing for the NASDAQ. We'll see what happens. Terry Sawchuk, you can find him online, Sawchuk Wealth. Always appreciate you being here, Terry. Thank you so much.
Good to see you, Steve, as always.
As always. All right. Keep the faith. Stick to the plan. Do not panic. I'll be back in a moment.